Hello everyone. In the last video, we followed the journey of money through a business. We saw that a company generates revenue, incurs different costs, and eventually creates profit. But if I ask you, how much profit did this company actually make this year? We need a structured way to calculate it. That's where the income statement comes in. An income statement helps us understand the financial performance of a business over a particular period. Let's start with something very simple. A business doesn't make money just because it exists or because it sells something. It starts with a customer need. The company provides a product or a service, the customer pays, and the company generates revenue. But that's only the beginning. The company also has to spend money to build and operate the business, whether that's construction, land, employees, maintenance, interest on debt, or taxes. So there are three numbers we need to keep separate: revenue, profit, and cash. They are not the same thing, and that's an important idea to remember throughout this video, that revenue is not equal to profit, which is not equal to cash. So let's start at the first stage. How does the business actually generate revenue? Let's take a simple example of a solar power company. Imagine a company owns and operates a 100 megawatt solar power plant. The plant generates around 200 million kilowatt hours of electricity per year. And suppose the company sells that electricity for rupees 4.5 per kilowatt hour. So how do we calculate revenue? It's simply electricity generated into the selling price. 200 million kilowatt hours multiplied by 4.5 gives us 90 crores of annual revenue. And here is the most important concept. Revenue is generally driven by two things: volume and price. For a solar company, volume could be electricity generated and price is the tariff. For an airline, it's passengers multiplied by the ticket price. For a hotel, the rooms occupied, the number of rooms multiplied by the room rate. For a SaaS company, subscribers multiplied by subscription fee. So before building a financial model, we need to understand one fundamental question: what actually drives the company's revenue? There must be some volume and there must be some price. Now comes the part where everything gets interesting. The company has generated 90 crores of revenue, but does that mean it has made 90 crores of profit? Absolutely not. The company has operating costs, depreciation, interest, and taxes. In our example, we start with 90 crores of revenue and progressively deduct these expenses. First, operating costs reduce the amount available from the business. Then we account for depreciation. After that, we consider interest on debt. And finally, we account for taxes to be paid to the government. Now, what we are left is the net profit. So, revenue tells us how much the business sells, but profit tells us what remains after expenses, after all you have incurred your expenses. Now, here is an interesting question. If revenue increases by 20%, will profit also increase by 20%? Not necessarily, because some costs may increase as revenue increases. And when a business has a significant amount of fixed cost, a small change in revenue can have a much larger impact on profit. This is one reason financial analysts pay close attention to operating leverage, which we will discuss more about in later videos. Now we have reached one most important concept in finance, that profit is not equal to cash generated by the business. Now you might assume that a 30 crore profit has entered the company's bank account. No, that's not how it works. Suppose the company has made sales of worth of 90 crores and customers have not paid 20 crores yet. The company may have recognized the revenue, but it has not received all the cash. So the company could have 32 crores of profit while cash collected from customers is only 70 crores. Why does this happen? A sale can happen today. The customer can receive the product or service today, and the company can recognize the revenue while the customer pays later. That unpaid amount becomes accounts receivable. And this is exactly why profit and cash are two different concepts. Profit tells us about the financial performance. Cash tells us what is actually happening to the company's bank balance. So let's now put everything together. This is the complete financial journey of a business. We start with a business model, like what do we sell? What is this business about? Then we think about the volume and the price, whether the price will be set by a PPA or whether it will be decided by the market. That gives us revenue. From revenue, we deduct all the costs which are required to operate the day-to-day operations of business. And after deducting that, we come at profit. But we are still not finished. We need to think about working capital, investments, financing, because these affect when cash actually moves. And finally, we arrive at cash, what actually comes into or goes out of the bank. So the journey is like that, and this is the financial engine of a business. Now let's apply this entire journey to our solar power project. We start with the business itself, that it is a 100 megawatt solar power project. The plant generates electricity which is sold to the customers. Now we calculate revenue using the quantity and the tariff, which gives us 90 crores. But generating that revenue requires operating cost, and there will be other costs also, like there will be depreciation, there will be interest cost. After deducting all these, we will arrive at profit. Now, the timing of customer collections, as we discussed in the last slide, the capital expenditure, debt payments, taxes, and working capital changes can all affect the cash flow. So even after calculating profit, we still need to understand how much cash is actually generated, and that we understand by all these components, which we will discuss later in the upcoming video series. Now, I hope we all have understood that a financial model does not stop at the income statement itself. We have to build the cash flow statement also. Now let's make this a little more interesting. Imagine two companies, both generate 90 crores of revenue and both report 32 crores of net profit. At first glance, they look almost identical. But look what happens to the cash. Company A collects 70 crore from customers, while Company B collects only 45 crores. Company B also has higher working capital requirements, higher capital expenditure, and higher debt repayment. So even though both companies report the same revenue and profit, the financial realities are drastically different. And this leads to one important question: which company would you rather invest in? This is how finance professionals think. They don't simply ask how much profit does the company make. They also ask how does the company make money? How profitable is it? How much cash does it actually generate? And how much does it need to invest in capex to keep growing? Because ultimately profit shows performance and cash provides the financial strength and flexibility. So now we understand the basic financial engine of the business. We started with the business model, moved from volume and price to revenue, then from revenue to profit, and finally from profit to cash. But this is where financial modeling becomes really interesting, because in a financial model, we don't just calculate what happened, we change the assumptions and ask what happens if revenue grows? What if costs increase? What if customers pay later? What if the company takes on more debt? And that's where we move from simply understanding financial statements to actually building a financial model. If you want to understand more about the financial statements, financial modeling, and renewable energy, stay tuned to my channel. Don't forget to hit the like and subscribe button. Get skilled with Disha. Stay tuned. Thank you. Happy learning.